Greenwashing, what does it mean, when it happens, and how to avoid it? Assets and funds that have sustainable objectives reached €4.05 trillion at the end of December 2021, representing 42.2% of all funds sold in Europe. This growing interest in sustainable finance presents asset management firms with new opportunities, but also risks. As there is no standardized definition of what makes a product sustainable and incomplete data, investors and firms alike concerned about the risk of greenwashing. Greenwashing, a situation in which a firm makes misleading or exaggerated claims about the environmental benefits of its products or services. Greenwashing results in loss of investors' trust and capital misallocation. Greenwashing has negative effects on business, litigation risk, as investors and other stakeholders have legal avenues to challenge asset managers on instances of greenwashing, reputation risk, losing consumer trust, also losing B2B partners, and financial losses. Since the fears of greenwashing are evidently justified, we have researched the literature to introduce to you some information about how greenwashing occurs and how to avoid it. Perfectly matching our research keyword, we came to the publication of Greenwashing Risks in Asset Management. Greenwashing can occur at three main stages in an investor's journey with an asset management firm. Stage 1, Pre-contractual stage. The lack of dialogue during pre-contractual stage between the firm and the investor and the varying regulations between countries increases the potential for misunderstanding in an area of finance. To ensure clear communication with investors, firms should ensure that they provide thorough fund documentation that draws clear links between fund names, objectives, and strategies. Firm-wide policies include information about the firm's overall stance on sustainable investing. Fund documents contain specific data limitation disclaimers and any pertinent information regarding issues that might hinder the fund from achieving the promised environmental impact. Stage 2, Post-investment stage and ongoing reporting. Regulators will expect firms to provide end investors with information to assess whether a fund is achieving its objectives on an ongoing basis. Firms should ensure that there is a consistent strategy used and displayed around non-financial metrics. In cases where new sustainability data on investee companies and funds emerges unexpectedly from various sources and could affect the fund's objectives, firm boards may want to consider third-party assurance on the data. If the numbers of greenwashing complaints are large or increasing, root cause analysis and reviewing existing firm-wide policies should be done. Stage 3, Complaints handling. Any complaints should be assessed fairly, consistently, and promptly. With respect to greenwashing complaints, firms should ensure that compliance or other relevant complaints handling staff are trained in sustainability investing, sustainability data, and so that they can determine whether greenwashing may have occurred. If greenwashing has been deliberate, it should be handled in a manner similar to other serious instances of misconduct. Firms need to incorporate controls against deliberate or unintentional greenwashing into their overall risk management frameworks. Firm boards should be aware of these challenges and tackle greenwashing risk throughout the pre-contractual, post-investment, and complaints handling phases. Visit our website. Follow us on LinkedIn, Facebook, Instagram, Twitter, and YouTube. Do Servantity surveyors truly appreciating your business?